So this is the USD CAD daily time frame. We had a market maker sell model execution. So here is the daily buy side liquidity. We swept this, came down, right? And we had came up into here into this BSC. Price came up into this wick like we wanted to. We can get rid of that. So if we go on the hourly time frame, you can see here we have this fair value gap. Price traded into it, and look, the bodies respected the consequent encroachment of the fair value gap. Came up, came back, respected the low end, and started heading lower. You can see here we had a little bit of a range where it consolidated and created sell side liquidity. And notice how they're small candles and they're just coming higher. So it's kind of like the way I like to think of it is it's taking a while for it to actually turn around and reverse. So it's just, to me, engineered liquidity. Here we have the hourly equal lows, which I believe on the daily they are also equal lows. So it's mostly hourly equal lows. Sorry, I put daily, but they're hourly equal lows. So let's change that. So you see here the hour equal lows created a bunch right here, traded higher into this area right here. Now we'll go into a lower time frame and we'll see why it was an important area. So since we are bearish, we can see here on the 15-minute time frame, price filled this SIBI. Here's the 15-minute SIBI. Came down, came up, and then moved down. So it created kind of like a, I guess you can call it like an order block that kind of filled in this fair value gap, moved away, created some engineered liquidity, right? Came down, reversed up into this order block right here. So if we were to measure this whole order block from here to here, you can see price came right into the consequent encroachment. Or sorry, the mean threshold, because for order block would be mean threshold. So 50% of that order block right here. So here we also have a 15-minute fair value gap. So we are bearish, so we expected price to reverse anyways, and we had these equal lows. So here, we have reason to go bearish here because we have a 15-minute fair value gap and a 15-minute order block, as well as already a balanced price range up here where price traded into and moved away from. So now we're just seeing where we can take a sell from. Now if we drop down to the 5-minute time frame, you can see in here we have the 15-minute SIBI, got respected by the bodies, reversed, came up. Here we have this little inversion fair value gap, came up, reversed down, engineered liquidity. And now here's the part where it's the market maker sell model. So we were bearish and we had an opportunity to either sell in here or at the 15-minute order block. But it came this high because you can see here, here's the original consolidation, right? Here you can see price is kind of bouncing around in this little area. Could be this whole area. And you can see here we have buy side that's just above this 15-minute fair value gap. So even if you did take a sell from here, you could have took a loss if you put your stop loss above here, but you should have kept this in mind right here, this 15-minute order block. So even if you took a sell from here, stop loss is above the 15-minute order block, which is up here, which you would have been saved. You would have been saved. So here is the buy side liquidity, and here is the smart money reversal up here. Now it happened in here because you can see we have this inversion reclaimed fair value gap on the 5-minute right here, which also acts as a balanced price range. So it came in here, moved away. Here's the smart money reversal. And I actually seen this on the 1-minute. So here we are on the 1-minute, and you can see we took out this buy side liquidity. Here's the original consolidation. And like it's taught in ICT's market maker sell and buy model, he has a market maker video, and it's taught that once you get a breakout, if price retraces into the original consolidation, you could have bought from here came higher, came up into this area, and you could have sold in here, but you might have gotten reversed on, because you have to keep in mind the higher time frame, PD arrays and everything, right? So you can see we came into here, came back higher once more. Here is the inversion reclaim fair value gap, smart money reversal, came lower, came up into here. Now, why would you not expect it to come up into here? First of all, you have a balanced price range right here. You have a balanced price range. Also, where it came below the fair value gap, which now becomes an inversion. So if you wanted to, you could have sold in here, somewhere in here, or at least at the 50%, and have your stop loss above the smart money reversal. So you can see here's where I got my kind of entry, because I was a little late. And so it was kind of like entered around right here, but from spread and stuff like that, you got to keep into account spread. And it came up into here. Here's another entry right here, or this whole order block. And it came down, took out the original consolidation, bounced around a bit, and then eventually came down into the hourly equal lows. So if I were to have held all the way down there, you could have got a good RR, but I didn't. So here's 1, 2, 4. But if you got from up here on the 50% equilibrium, because either you expect a reversal, you sold from here, because now it's an inversion. So this could have got you a way better risk to reward. The original consolidation would have been a first take profit, and the hourly equal lows would have been your final take profit, which could have got you a good trade of 1 to 5. Now, of course, we didn't get that, but it's still something that could possibly happen. And you can see here's the original consolidation. Now, if we drew a manipulation leg as well from the smart money reversal to the low, this could have been a profit target as well. Now, let's see. Let's use the price now right here. Notice how those line up together. Here is the highest swing projection that caused the last manipulation leg. So you can see it came up in here and then reversed. So if you measure that from here to the low, the big swing, that is where you can project the manipulation leg. And you draw the standard deviation from high to low, since we are in a market maker style model. And you could target the next standard deviation is below the original consolidation, which you see right here, right to the tick. Now, I did only target the original consolidation, and then price came down here. But anyways, this is for the notes as to this is for the notes that I'm going to be putting in my Discord. I will have a market maker model section where it will break down how to find these, and it's just notes on ICT's video. It's just notes, and I'll create a playlist, and this will be added into the notes on the Discord, and you can watch these as, I guess, a review. It's mostly just for myself, but feel free to watch them as a review. But yeah, this is one of the market maker style models, and this is why it came up in here. We have to be careful too, because it is January, so price is not really it's not really the best for entries and exits. So you want to kind of get in and get out. But this is what I've seen. Here to me is the original consolidation, and you can see it came out right here, broke out, and then came back in where you could have bought from and targeted wherever you thought. I would have probably targeted somewhere up here, because I didn't really see this until it happened, and then I caught a sell in here somewhere. But yeah, caught a sell around here because I tried to sell at the inversion, so it was like around right here. Yeah, you can see even came below the standard deviation. It was below the hourly equal lows. It came down right there as well. And that's it.